Welcome, everyone. Kevin and I ready to go with another Financial 15, going back to our original series, Behavioral Finance, this time looking at wealth and happiness. Lots of great information. You definitely want to stick around.
Yeah, anytime you start finding markets going down or talk a recession or things like that, people start worrying about their wealth position and how it's going to affect them down the road and things like that. So we want to make sure that you're described what's going on with wealth and happiness. If you want to find this video or any of the others in the original series or any of them that we have all together, please go to our YouTube channel and subscribe. Really simple, quick to do. Or like us on Facebook, and most importantly, visit our website at beckerorr.com. Lots of great content there. You'll find this, you'll find everything else you need packaged up really nice and tidy. But today we are dealing with wealth and happiness. Do the two relate together? If I have more money, does that make me happier? Is it a big play? I mean, all these questions need to be answered. Clint, how does the wealth and happiness thing work together? Is it income-based? How are we dealing with this?
Yeah, and we're going to go through a couple of studies here, a little bit of data to help us answer some of those questions. I already pulled the first one up here, Kevin. This one is income and happiness. You can see it as a paper. I'll point that out so you have their appropriate sources for all the research. That was done in this particular category, but they looked at a few components here, Kevin. They broke it down. Very nuanced study that they looked at. They looked at the positive effects right here, the negative effects, and then what they call life evaluation, which is an element of subjective life evaluation. All three of them form what they call subjective well-being, but quick explanation. They're saying the negative effects, as you make more money, well, instance of stress and anger, all those negative items, they tend to decrease, right? And the positive effects, you get joy, you get more happiness, more optimism. Those hopefully go up as you make more money. And then the life evaluation, that'd be your subjective evaluation of your life, ideally increases as you make more money. But you can see it goes to a point, right? It doesn't go on forever. You get more money is not always the answer. And that's what they're trying to find. What is that point of satiation? And then how does it vary across the world, different countries? You can see the results here. Globally, they had an average about 95,000 for that life evaluation. Interestingly, the positive effects, they stopped at about 60,000. Negative effects, the decrease in anger, stress essentially went to about 75,000. And you can see how all those different points would vary by education level here, by gender, and then by the various geographies as well. What's your first takeaway here, Kevin?
Yeah, I mean, basically what we're seeing, and again, we are dealing here with a household scenario. We're not dealing with individual incomes. We're dealing with household total, is that you sort of see where, I mean, with the way inflation's worked and everything else, that, you know, you're around that 100,000 mark. It seems to be on a global basis. But again, where you are in the world and what your education levels and things are huge. I mean, if you've grown up in a low income scenario and you didn't have that higher education, as we see on the bottom, your happiness level really kicks in a lot quicker than those that have a higher expectation or a higher education, because they expect to have more just based on that sort of scenario. So yeah, I would say and the other factor to receive is that your positive results come a little quicker than the elimination of the negative ones. The more money you make eliminates a lot of those negative stress factors. Whereas, you know, you can start being very happy after a smaller positive kick. So, I mean, it's interesting to see how that works, where it's, you know, more people would think that the positive might be higher and the negative might not be quite as bad. But I mean, it seems to be more of a situation where it's a mix there, but the negative aspects leave after you get a lot more money going forward.
Yeah, and they had to make a few assumptions to explain some of the data here when they calculated these items. So first off, it is US dollars. So they had to find a common currency around the world. So looking at US dollars, it is a household income. But if you had multiple family households, so you had like 3, 4, 5 people in a household, there would have to be a conversion done to get to that income number. And then obviously there's going to be a bit of an average or a bit of a median, because North America, there's some pretty big differences there. If you live in Winnipeg, or let's say you live in Fargo compared to Manhattan, the level of income you need might vary. But again, they're trying to find kind of an average for that satiation point. And it gives you a very good idea, very good discussion factor there. And you hit the nail on the head when you mentioned expectations, right? It's a subjective element. It's our kind of financial behavior, our expectations, which influence all of these different points. And then an interesting part, we're just looking at that first column now, that life evaluation, not the positive or the negative effect, just zooming in on the life evaluation by the different geographies. And you can see the points. That's what these dots are. But noticeably, some of the geographies, most of them, in fact, after they got to that satiation point, more income actually resulted in a lower evaluation. So their subjective evaluation of life actually went down, Kevin, as they got past that satiation point. What do you make of that?
Well, yeah, I mean, and that's sort of an interesting scenario, right? A lot of people figure the more money you make, you're always going to constantly be happier and happier. But no, you hit a certain point, and then after that, sometimes it becomes more of a burden. Well, I've got more taxes I have to pay. What am I going to be able to do with this? Where does this go? I mean, it's not necessarily that the more money you make constantly. I mean, if you make $1 million a year, making 3 million may not make you happier. It may put you in a situation where your life goes down more because you have more obstacles that you have to deal with. And also, if the graph takes a look, if we notice the happiness levels and the income, if you are in a non-developed area right now, your income levels are a lot lower where you have to hit these saturation points and you seem to go down faster. Whereas those that are more developed, it's not quite as extenuated. Look at North America, Australia. I mean, when you start taking a look at those sort of scenarios, it does prove that, where you've lived and grown up may have a little bit of an effect on that as well, based on your income levels.
Yeah, and we talked about that in prior videos about the environmental influences of where you grew up and the experiences you go through and how it impacts how you handle money. You're seeing an impact in your expectations, which impacts your subjective well-being around money as well. And it's also reflected here in that graph. We'll move along here talking age and happiness, Kevin, and good news. You're beyond the peak unhappiness point, but according to this study, I'm rapidly approaching peak unhappiness. But what we look at here is across the globe. I'll quickly explain. They have the different countries, and they have the numbers here at the bottom saying that's the level where you kind of hit peak unhappiness. Then after that, you start to get happier, you get older and into retirement. And it varies by country. That's the idea. The darker shaded countries have a higher level and the inflection point a little lower for your lower shaded countries. We'll turn that into a graph to make it easier to look at. And you can see the U on the unhappiness part. And then you can see the opposite, the upside down U when it comes to the stress levels there. Kevin, what do you make of that?
Yeah, I mean, basically what it's saying is, as you're seeing, I mean, the level of happiness, you start to get down to that point, and then afterwards you start, moving back up the scale again. And I look at more levels on the stress side of things, that if you look at it, you get to a certain point, sort of that 30s, at least in North American side. On the other side, it's a little higher than that. But after you hit that sort of 50 time frame, everything starts going down a lot less stress. There's a lot less to worry about. Maybe the mortgage is all paid off. The kids are in school or in the university, you've got that covered. You start getting closer to retirement, everything starts to ease down a little bit. And again, it's all perception, right? Not necessarily does that matter, but I mean, as you get closer to certain things and there's less stuff that you have to worry about going forward, house is paid off, you've got money in the bank scenario, you get less stress going forward. Whereas the happiness sector on the other side is sort of the reverse sort of scenario with the upside down U.
Yeah.
Or should I say the normal U?
The normal U. Yeah, the happiness U curve. A few of the points here for the stress, the inflection points, according to this particular study. You had 35 on the first one there, 45, and then 51. So the least happy countries had a later inflection point for the stress. And then in terms of age, where you see the inflection point, you start to see that happiness curve go up. The happiest countries was 44, 55 for that middle countries. And then the least happy country is 67. I think the idea here is when you're young, Kevin, you have your whole life ahead of you, so lots of optimism, You're happiest. As you approach older life, you've got a little more wisdom, a little experience. And then middle age seems to be that midlife crisis, the unhappiness sweet spot, right? Old enough to have some regrets, but not old enough to have the wisdom to let things go. So you're kind of stuck in that middle ground. But we talked about wealth, income, and happiness across countries, age and happiness across countries. Let's pull all of that together and wrap it into retirement. Looking at another study here. And I think most folks, Kevin, they go into retirement, they're thinking money, income, asset levels. That's going to be the key to my happiness in retirement. This study kind of flies in the face of that, doesn't it?
Yeah, and I mean, we basically talked ever since time, and most people figure it's, they want to get their retirement or their financial plan done. It's how much money do I need to retire, or will I have enough money to retire? And that seems to be the biggest topic. But at the end of the day, as this study is showing, that is not necessarily the biggest factor. I mean, economic well-being, as it says, is not increased substantially by getting a whole bunch more. I mean, there is an effect to having income and wealth to a point, but it's a relatively small factor going forward. And as I say on the second point here, I mean, the definition or the happiness level between defined benefit and defined contribution or no pension. Well, if you know you're getting a specific amount of money each and every year, and maybe it's indexed, you're very happy to have that going forward. Where those that, okay, well, here's the giant pot, let's hope you can make it last, depending on how things go, you're not quite as happy on that level in scenarios with income and wealth. But again, that's a small factor, isn't it? There are two factors that we've got listed there that are more important.
Yeah, I mean, the defined benefit plan, that was kind of like a neat little insight as part of the study. The first one, the economic well-being as measured by income and wealth, does not have a big increase overall for your subjective well-being, a small, relatively small increase. But the two keys, according to this study, which, by the way, was done by the Center for Retirement Research at Boston College, the two keys for them was voluntary retirement versus involuntary retirement. So a sense of control there, in my opinion. Those that say they voluntarily retired had expressed much higher levels of well-being compared to those that did not voluntarily retire. And then this one, no surprise, the second major factor they found for happiness in retirees, health. Retirees with poor health experience dramatically lower levels of well-being. But note there, the two big factors, neither one of them is money, Kevin. It has to do with a kind of a sense of control if you're voluntarily retiring, and then your health in retirement, which makes a little bit of sense, right? What's the point of having all the money in retiring if you can't actually enjoy it or do anything with it?
Well, and that's exactly, I mean, that's the biggest factor. And no matter what happens, when you get into that retiree statement, and when you talk to retirees, their biggest concern is health, to be able to do the things they want to do. And that might not involve travel, but maybe it involves gardening or working around the yard or things like that. If you don't have that factor, all the money in the world does not matter, no matter what's going on. And again, being able to decide when you want to retire, probably much easier. I mean, if you're forced out at 65 and you don't really think that you're ready for retirement, okay, now how's that going to go? So again, voluntary retirement, you're right, and especially health. Those are bigger factors than what the money is that you've got. If you don't have your health, you can't use it. So as they say, you can't take it with you. So you need to have the health to be able to continue on.
Yeah, and this all has to do with expectations, all three of them, because it's a subjective level of well-being. Our happiness isn't just something we can tick off on a checklist, right? It has to do with what we experience compared to what we were expecting to experience. And that kind of plays through all of what we just talked about. That first piece about income and happiness, well, a lot of it has to do with what you expect to make in terms of income.
That's right.
And then in that second one with age and happiness, a lot of it has to do with where you think you're going to be in life and where you actually end up. So again, your expectations have a big influence on that. And that last piece on retirement, you just hit the nail on the head with voluntary retirement versus involuntary retirement. Well, if you weren't expecting to retire, then that change is forced upon you. It could be stressful. You could have negative reaction to it. So certainly our expectations play into this on multiple levels when it comes to wealth and happiness. Anything you want to add before we close it out here, Kevin?
No, I think that covers a lot of it. Again, we want to just make sure that you know that wealth and happiness, there is some correlation, but again, it's not the only deciding factors. And there's a lot that goes into it. And as Clint mentioned in the last part there, expectations are very big. If you want to know more about this topic, though, or anything else we've done in our original series or any of the other videos we put out there, please feel free to get in touch with us with chatwithclintonandkevin.com, because we're more than happy to answer your questions and get them out to you as fast as we can. So by all means, if there's anything else, please get in touch with us. Otherwise, I think we've covered this topic fairly well, and it's time to move on to another one.
That sounds good. Take care, everybody.